Understanding from you better the sources of returns in this fund. One part, as we understand, is the rollover spread that we talk about in normal parlance. And let's say a portfolio has been rolled over to this new month, the spread has been locked in. Now, during the month, what are those drivers or what are those triggers that would lead you to change the positions or square off riding on volatility basically?
So let's understand that what happens in this fund when we put a trade, right? So on the day one when you put money, the first trade what we do is we'll be going long on equity shares of an X share and we'll be selling the futures of the same underlying, right? So theoretically you have locked in your trade, your position is completely hedged. Now how will you realize your profits? On the expiry day, in a normal circumstances, on an expiry day, your futures will expire. Since we have physical delivery, which means you will have to give up the delivery for your short shares. You already own the equity shares, you will give delivery to the exchange and your trade is squared off. Now this is the normal trade where your profit is realized. In a practical world, what happens is that there is instances where you will let your futures expire and you will give the delivery, or you will roll over your position from the current month to the next month. So let's take example that you are in the month of September, and if the expiry of the September comes at around 30th of September, what you will do on that day, either you will square off your position or you will roll it over. Now how will you roll it over? You will square off your existing futures position, which means the month of expiry of September, and you will sell the October series. So that means your position, how will your position look like at that point in time? You will be long equity shares and you would have sold the October futures. So that is how rollover. Now the difference between the September series of the futures and the October is what you will capture as your profit for the next month series. Now this is what happens on a rollover. There are multiple instances, as I told you, the demand supply mismatch can happen, which I told you just earlier. There can be a change in the spread, which means that the spreads can actually widen or compress. Now time when the spreads compress, you actually have the opportunity to enhance your return by squaring off that trade during the month rather than waiting for the expiry and actually redeploying the same money into another trade which is trading higher than what you have squared off. So typically what happens is that if there is a volatility or there is a supply demand mismatch which creates to the differentiation in the spreads, you actually have the opportunity to enhance your profit in conjunction to what you have already locked in the spread.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.